Hello and welcome to Lecture 11, Part B on Quantitative Financial Statement Analysis. In the course so far, we've learned about financial statement analysis from a fundamental perspective. That is, for an individual company, we go through and read their financial statements, conduct our accounting analysis, look at the ratios, forecast future performance, and then do evaluation. However, some people will try and attempt to do all this in a quantitative method using empirical archival research, which means look at thousands of companies at once and see if there's any patterns that we can take advantage of to either uncover accounting problems or improve our forecasting or improve our valuation strategies. So I thought it's a good idea to be exposed to some of these different ideas compared to what we've done in this subject, which is look at one company at a time. So quantitative models are often developed by accounting and finance researchers. If you're interested in doing honours in the finance or accounting discipline group, you'll be able to do research in similar kind of vein to what we're going to look at in the future. So if you've been a good student in your accounting major and you're not sure what to do next year, consider doing the honours program and you'll be able to implement some research work. And if valuation's your area of interest, you could think about some of these models and how you might try and value companies in a wholesale manner or improve forecasting techniques. Anything like that could be something you could consider as a research project. So the first quantitative model I thought we'd talk about relates back to when we did accounting analysis. When we studied accounting analysis, we looked at a firm and we read their financial statements and tried to understand if there were any red flags about their accounting that maybe looked a bit off and maybe gave an indication that the firm might be manipulating or biasing their financial statements. An academic, Benish, created a model called the M-score, and what it does is it calculates the probability of earnings manipulation. So the M-score is this quantitative model here. It's using a statistical technique called a regression. So the model takes into account different financial variables. So I've linked just to the Wikipedia article here, which discusses what these different variables mean. And they're numbers from the accounting statements or the financial statements. So, for example, things like the total assets and sales, general and admin expenses, depreciation, all these different things times by these numbers which are figured out by this statistical technique called a regression. And what it does is it comes up with this number for every company, and that number can then be used to evaluate if the probability of earnings manipulation or accounting fraud. And what that can be used for, this article from the Financial Analyst Journal, which is a CFA run journal, so for financial analysts, which is what we're doing in this subject, earnings manipulation and expected returns. They find that companies with a higher probability of manipulation using that M-score measure earn lower returns on every decile portfolio sorted by size, book to market, momentum, accruals, and short interest. Last week we learned about different factors that help predict future earnings, such as the Farmer French factors. Things like small companies outperform big companies. Firms with a high book-to-market value outperform companies with a low book-to-market. So across all these different factors that we know influence returns, this M-score also influences returns. So firms with a high probability of manipulation earn lower returns. That makes sense. They're more likely to get caught. They're more likely to be unable to continue their fraudulently high accounting earnings, and when things get uncovered and the accruals work out, then their future returns will be much lower. So we implemented an accounting analysis firm by firm. Using this model, you could implement an accounting analysis on all firms at once. It takes away some of the subtlety and nuance of our individual accounting analysis that we conducted, but it does provide some benefits in that we can test it statistically and see how our company compares to others in a very factual kind of manner. In a similar trend, DeChow et al. Calculated something called an F-score, and it uses accrual quality, financial performance measures, so accounting information, non-financial measures such as the number of employees and things like that, off-balance sheet measures, and market-related variables like stock returns. And they've also created this model based on all the companies in their sample that had been in trouble in the US for accounting fraud or accounting enforcement actions where the regulators have said you've done your accounting wrong. So they've used a sample of all the firms that had been in trouble by the regulators and came up with all these different ways of predicting which firms are likely to have accounting enforcement actions. So again, a different way of conducting your accounting analysis using some quantitative models. Another thing that's often done in a quantitative sort of methodology is trying to predict firms that are going to go bankrupt. So this started out in 1968. The Altman Z-score is a really classic model, which for manufacturing firms, again, it used a regression technique, and it comes up with this formula that will predict if a company is going to go bankrupt based on their financial statement information. Now, it's been altered many times, and more modern versions such as Campbell et al. Have different models using regressions to predict financial distress or bankruptcy. So we did ratio analysis and looked at liquidity ratios and solvency ratios, and then did a cash flow analysis, and we were trying to think about how safe a firm was to invest in if it's likely to be able to continue in the future. We could have alternatively applied one of these models to come up with hopefully a similar kind of outcome. The Campbell model, predicting financial distress and the performance of distressed stocks, finds that distressed stocks, they're the ones that this model predicts are more likely to go bankrupt, have very low returns. These returns are low relative to the market and adjusting for their high risk. Okay, so the underperformance of distressed stocks is present in all size and value quintiles. So again, we know size and book to market ratios influence returns. So this distressed stocks measure influences returns both in small firms and large firms, low value, high value firms. Okay, so we could do our solvency and liquidity ratios company by company, or we can implement models like this that take into account our accounting information and other market information and try and model this and build a prediction model for bankruptcy. Next up, when we're implementing our stock picking and we're valuing companies, trying to find those ones that are undervalued to buy, we're doing it company by company. And accounting professor Petrosky, he created what's called an F-score, different to the F-score from the prior paper, and this one predicts the strength of a company's financial position, and it utilizes 9 measures of profitability, leverage, and operating efficiency. If you can remember back to your accounting B, or when we discussed basic DuPont analysis breaks down a firm's financial performance into profitability, leverage, and operating efficiency, which includes asset turnovers and profit margins. So he's created these 5 different financial ratios and put them together into a model. And if you invest in firms that have a higher F score from 1974 up to 2014, the companies in blue, that's the returns of high FS score, which is similar to the F score. Red is the F score, and green is just the biggest 500 companies in America. You can see by implementing this model and only investing in higher quality companies that have higher quality accounting, it generates significantly higher returns for those investors. So overall, this was just a quick discussion on quantitative models. What we've learned in this subject is fundamental analysis. We know how to read the financial statements and get important information out of them. And that's a really important skill, but we can't do that for every company in the market. So these quantitative models can often help out because we can quickly apply them to all companies and see what's happening across accounting fraud or in predicting higher quality companies. And they can be very useful to then supplement or complement our fundamental analysis.